clearly most of the foreign currency deposits in China are in US dollars. And so now when Chinese banks take US dollar deposits, they can't make as many loans. They have to hold more dollars than they had been holding. And so the idea here is that this is going to increase dollar demand in China because the banks are now going to have to buy more dollars or hold on to more dollars, so not sell as many dollars. But I don't think this move is going to provide any significant support to the dollar. The question is this an indication that the bank is going to do more to try to slow down the dollar's decline, which I think would be a mistake. I think monetary authorities should let the market function and let the dollar fall. The dollar is going to be falling against a lot of currencies, not just the yuan. But one way that this might backfire, if the goal of the policy is to strengthen the dollar, is if Chinese banks, which now have to hold more dollars in reserve, and so they can't loan out as many, maybe they will also reduce the interest that they pay their depositors on their US dollars, because obviously they can't make as much money loaning out those dollars. And if they do that, then that will simply widen the disparity between what you can earn on your RMB deposits or yuan deposits versus what you can earn on your dollar deposits. And that may cause more people in China to decide that they'd rather bank their yuan than dollars. And so what they end up doing is selling their dollars so that they can convert their deposits to yuan and earn more interest. Now, this is going to happen anyway as the dollar really starts to fall and the people in China start to perceive the risk of holding dollars, and they would prefer the safety of owning local currency. So that is going to happen anyway. But also, there's been a lot of people who have pointed to the Chinese currency peg, and they said if it wasn't for this peg, it's the Chinese yuan that would fall. That somehow by pegging the currency to the dollar, they are having an artificially strong currency, but for that peg, the yuan would crash. Clearly, when the central bank is intervening to support the dollar, that's not true. It's the dollar that's going to crash if China pulls the peg, not the yuan. And in fact, the main reason that the FX reserves are so large in China is because that's how many dollars they've had to buy to prevent the dollar from falling and to artificially suppress their own currency. And so I think that domestic purchasing power is becoming far more important than exports to the United States. And so trying to artificially suppress the purchasing power of their own currency is no longer a primary concern. They're going to have a lot more people to feed and to take care of, and so they want more purchasing power. They want to try to see the cost of raw materials and all the things that people are going to need. They want to see these things come down, and they're going to be more concerned about satisfying the demands of their own population, which is now going to really start to grow, as opposed to satisfying the demands of the American population, which is now in a lot of trouble because we're going to be fending more and more for ourselves. And we do not have the capabilities of doing that because over the years, we've grown dependent on countries like China. And so our economy has disintegrated. Our industrial capacity no longer exists. We have seen the economy transform into a service sector economy where consumers borrow money to buy stuff they didn't buy, but all this is dependent on the reserve status of the dollar and our ability to import the stuff that we didn't make and borrow the money that we didn't save. If you think about, again, the classic Milton Friedman inflation, which is what inflation is, which is too much money chasing too few goods, you print more money and it bids up the supply of goods. What has been happening in the U.S. economy? The Fed prints all this money, yet that money doesn't lose a lot of value. Look at the exchange rate of the dollar versus other currencies. We've had this massive explosion of money printing, big increase in the Fed's balance sheet. But on a relative basis, the dollar hasn't lost a lot of value relative to other currencies, despite the fact that we've dramatically increased the supply. Imagine if the United States existed as an island. We didn't trade with any other nation. So any money the Federal Reserve printed just stayed within our borders. It didn't go anywhere, right? And so the only stuff you could buy with the money the Fed printed was the stuff that we made here domestically, because that was the only source of goods. Well, obviously the effect would have been much different. because if the Fed prints a bunch of money and we don't have any stuff, we're not producing, we don't have factories making stuff, then the prices are obviously going to go way up. But there was kind of like an escape valve that allowed the Fed to print a lot of money and it not push up the price of goods. And that was the fact that we have a whole world out there that was able to produce the goods that the US economy couldn't. And we were able to take all the money that the Federal Reserve printed and then use that money to buy all those goods that were made outside the United States. So the Fed prints money, the government gets it, sends it to Americans. Americans take that money and buy Chinese goods with it. And now the Chinese send us their goods and we send the Chinese our money. So the money the Fed creates is shipped abroad. So it's not in America bidding up prices, but now the goods that the Chinese produced, they get shipped to America. So now we have all those extra goods to keep a lid on prices. And if you look at the breakdown of the CPI between goods and services, if you just look at services, you've seen a substantial increase in prices, even with the government rigging the CPI, because the cost of services has actually risen by more than what the government admits. But if you strip out goods, you'll see a much bigger increase in prices. Why? Because we can't easily import those services. There isn't a foreign alternative. You can't outsource that stuff because the services have to be performed locally. But when it comes to goods, more and more goods have been outsourced to cheaper production economies like China. And so that's kept the lid on goods prices. And so when you average the goods prices with the service prices, that's kept the measured rate of inflation lower. I mean, think about the low production costs in a country like China, which, 20 years ago, they were just starting out. They went through a long period of time where they had a communist system, not just in name, but in practice. And so you had a lot of very poor people. And as they began to embrace capitalism, wages started at a very low level. And of course, they didn't have a lot of the rules and regulations that we had. They didn't have all these environmental protections. And so the cost of manufacturing and the cost of labor, capital was all much lower in a country like China. And so we were able to outsource that production in order to keep costs down, even as the Federal Reserve was printing money. And of course, the money that we were printing, we were sending abroad. See, now normally this wouldn't work, because if you ran a big trade deficit like the one the US is running, your currency would crash, because your trading partners would have all this currency, but they'd have nothing to buy, because the whole purpose of trade is that you export to import. You have a concept of comparative advantage. And as a nation, there are certain things that you can produce efficiently, and there are other things that you can't. Rather than producing everything, you produce just what you can make efficiently, and then you trade that for the things that you don't produce efficiently, because maybe your trading partner can produce that more efficiently. And so by everybody concentrating on what they make efficiently and then trading, everybody ends up with more stuff, higher living standards, lower prices.